When people hear that I invest for a living, they usually end up asking me the same question. If you had to start over from zero right now, in 2026, what would you do? Not with millions, not with rich parents, not with a lucky lottery ticket. Just an ordinary job, a few thousand in the bank, maybe some student loans, and a whole lot of questions. If that's you, this video is for you. Because yes, the world in 2026 is noisy. You've got AI, crypto, meme stocks, zero-day options, money flying around social media. But underneath all that noise, the rules of wealth are the same as they were in 1926 or 1960. Math hasn't changed. Human nature hasn't changed. Compounding hasn't changed. So in this video, I'm going to walk you, step by step, through exactly what I'd do if I had to rebuild from nothing in 2026. Not vague advice like, buy good companies, or think long term. You've already heard that 1,000 times. I'll give you a concrete game plan, how I'd set up my finances, what I'd read, where I'd put my first dollars when I'd move from index funds into individual stocks, what I'd avoid completely. And one more thing before we dive in. This is education, not personal financial advice. Your situation is your own. Use this as a framework and adjust it to your life. All right, let's start with the part nobody wants to hear, but everybody needs to face step one. Before I or if I were starting from zero in 2026, the first phase is simple. I wouldn't try to get rich. I'd try to get stable, because if your financial life is shaky, it doesn't matter how smart your investing is. One emergency, one job loss, one medical bill, and you're forced to sell everything at exactly the wrong time. So here's exactly how I'd get my house in order. The one, kill expensive debt first. I'm talking about high interest debt. Credit cards, buy now, pay later balances, personal loans with double-digit interest. If it's costing me more than about 7-8% a year, that's my first investment. Why? Because paying off a debt at 18% is like earning a guaranteed 18% return on your money. There is no safe investment in the stock market that promises you that. So if I had, say, $5 out at 20% interest on a card and $4,000 in cash, I'd wipe out as much of that balance as I possibly could, and then attack the rest aggressively month after month before I even think about picking stocks. 2. Build an emergency buffer. Next, I'd aim for an emergency fund of a size 3 to 6 months of essential expenses. Rent or mortgage, groceries, utilities, transportation, insurance, basic health care, not your vacations, not nights out, just what keeps you alive and housed. And I'd keep this money somewhere boring and safe, a high-yield savings account, a money market fund at a brokerage. This cash is not there to make you rich. It's there so you don't have to sell your investments during a crash just to cover rent. 3. Lock in a habit of living below my means. Then I'd attack the most powerful number in personal finance. For income expenses to freedom, that gap is your fuel. The wider the gap, the faster you get out of the rat race. I'd track every dollar for at least 60-90 days. Use an app, a spreadsheet, or a notebook, doesn't matter. Find the subscriptions I forgot. Notice the Uber Eats bills, spot the Amazon impulses. And I'd start cutting, not because I'm broke, but because I want Oz options later. Remember, every dollar you don't spend today can hire a little worker for your future. You can send that dollar into the market and let it bring friends back home over time. Once I've destroyed high-interest debt, built a basic emergency fund, proven I can live below my means, now I'm ready for the next phase. 2.5 Steppy 20. Bquam dangangar osly educata abo manui. If I were starting over in 2026, I would not rush into picking individual stocks. I'd rush into learning. Because investing isn't about memorizing formulas. It's about learning to think clearly about as businesses and behavior. Here's exactly how I'd do that. Read the foundation books. I'd start with a short reading curriculum and go slowly but deeply. Books I'd study. The Intelligent Investor by Benjamin Graham, to understand value, margin of safety, and what it means to be an investor instead of a speculator. One Up on Wall Street by Peter Lynch to see how a professional investor uses everyday life to find great businesses. Common Stocks and Uncommon Profits by Philip Fisher to understand what makes a truly great growth company. A collection of shareholder letters from great investors and CEOs of Buffett, Munger, Jeff Bezos, etc. to see how real decisions get made over decades. I wouldn't just read these once. I'd underline, take notes, reread, pause when something hits me, try to explain the idea out loud in simple language. Because the goal here isn't to sound smart, it's to think straight. S2, study businesses, not tickers. Most beginners treat stocks like lottery numbers. If I were starting over, I'd ignore the stock symbols at first and look at Tazari's actual businesses. How do they make money? Who are their customers? What problem are they solving? Why do people keep coming back? What could put them out of business? I'd walk into stores. Watch what people actually buy. Listen to what they complain about. Look at which apps are on everyone's phone. Some of the best investment ideas are hiding in your daily routine. The coffee you drink every morning, the software you use at work, the brand your kids always ask for, the service your neighborhood can't live without before buying anything. I'd practice seeing businesses everywhere. If I step 30 start, I investo T smart. Why once my basic finances were stable and I'd started my investing education, I would finally put real money into the market. And here's the key. I would not start by picking individual stocks, even though I know how, even though it's more exciting. Instead, I'd begin with broad, low-cost index funds, OSY index funds first, because when you're just starting, you have limited time, you have limited money, you have unlimited chances to make emotional mistakes. Index funds solve 80% of the problem right away. If I lived in the U.S., I'd probably choose a low-cost S&P 500 index fund, something tracking the largest U.S. companies, or a total U.S. market index fund expense ratio, ideally ERS are under 0.10%. Then I'd set up an automatic deposit every paycheck, invest as on a schedule, not based on feelings. Keep buying whether the market is up, down, or sideways. This is called dollar cost averaging, putting in the same amount at regular intervals. So you naturally buy more shares when prices are low and fewer when prices are high. And while those index funds quietly grow in the background, I'd be doing something just as important. Fangfei step 4, so what do I actually rescue while my main money is going into index funds? I'd be training in the background like an athlete. No pressure, no rush, just skill building. Here's how. Pick 10, 15 companies to follow. I'd choose businesses I've already interact with, the payment app I use, the retailer I shop at, the phone company I'm with, the software my company runs on businesses in the industry I work in. Then I'd pull their annual reports and ton Ks from their investor relations websites. It's all free, yes. They're long. Yes, parts are boring. That's the point. The gold is often sitting in the sections everyone else skips. Archivage 2. Ask myself simple but deep questions. As I read, I'd ask, how exactly does this company make money? What does it actually sell, and to whom? If I owned 100% of this business, what would worry me at night? Who can realistically take their customers away? Is this more like a fad or a basic need? I'd write down my thoughts once a quarter for each company and compare them against what actually happens over time. Did sales go up like I expected? Did management do what they said they would? Did competition get stronger or weaker? This is how you build what people call a FF, circle of competence, the set of things you truly understand well enough to put real money behind. And I'd be patient with myself. I'd give this phase 1 or 3 years while my index funds quietly grow, like step 5. BUNGMY FAR CT individual sto CT or IGHT, where at some point after following businesses for long enough, I'd find a company that checks 3 boxes. 1. I understand what it does and how it makes money. 2. It has a durable advantage, something that makes it hard to copy. 3. The price is clearly cheap compared to what it's worth long term. That's when I'd buy my first individual stock. what would that first stock look like? It would probably be as boring. A bank with conservative lending practices in an area I understand, a consumer staples company, the boring products people keep buying in any economy, a utility or infrastructure business with predictable cash flow, a software company that my industry runs on. With sticky customers and low churn, it would not be the latest hyped AI stock just because everyone on social media loves it, something I bought because of a tweet, a company whose business I can't explain clearly to a 112-year-old. My rule would be simple. Char, if I can't explain in plain English how this company makes money and why customers stick around, I don't buy it. How much would I put in? At the beginning, I'd start small, maybe 5–10% of my total portfolio in individual stocks. The rest still in index funds. That way, if I'm wrong early on, and I will be wrong sometimes, I'm paying tuition, not blowing up my future. Over time, as my skills grow and my confidence is actually based on work, not emotion, I'd slowly increase the percentage in individual picks. 2 fund for face step 60. DIVR Sefekon VS Celluosado Ayad Bilan Site. You've heard, don't put all your eggs in one basket. You've also heard the opposite. Bet big on your best ideas. So what would I do starting in 2026? I'd combine both. Use index funds as my foundation. My broad index funds would stay as the foundation of my portfolio, probably forever. They give me instant diversification, exposure to human progress, a safety net if a few of my stock picks are wrong. Think of it like this. Index funds, the solid concrete foundation of a house. Individual stocks, the rooms I design more uniquely for to. Concentrate only where I've earned the right. As my skill and experience grow, I'd allow myself to build a concentrated set of individual positions. Maybe 5–10 companies I know extremely well. No need for 50 different names I barely understand. The key idea, sure, diversification protects you from ignorance. Concentration rewards deep understanding. But I'd never go all in on a single company. No 100% bets. No margin loans to lever up. A rough guideline I'd follow: no single stock more than 20–25% of my portfolio. Individual picks in total might eventually reach 40–60% of my portfolio. Depending on my opportunities and risk tolerance, the rest stays in low-cost broad funds. 25K Step 7 cash. If I were starting over in 2026, one of my secret weapons would be cash. Not as an investment, as an option. Even once I'm fully invested in my core positions, I'd keep 10–20% of my portfolio in cash or cash-like assets. Why? Because markets don't just go up. They overreact, panic, overshoot on the upside, and the downside. History is full of moments when great businesses got temporarily priced like they were going out of business. Crashes aren't events. They're when events. So here's what I do. Maintain that cash slice during normal times. Keep a watch list of great businesses I'd love to own more of. When the market drops 30–50% and fear is everywhere, start moving cash into those businesses steadily while others are forced to sell at the worst possible time. I want to be one of the few people with money ready to buy. Cash is not lazy. It's a patient ammunition. 2 Step 8. If I'm in my 20s, 30s, even 40s, and I'm focused on building wealth, I don't need my investments to pay my bills yet. So every dollar that comes in is a dividend. I'd send it straight back into the market, either automatically reinvested into the same fund or stock, or intentionally redeployed into my best existing opportunity. Think of it like growing an orchard. The trees, your original investment grows, it starts dropping fruit, dividends. Instead of eating all the fruit, you plant most of the seeds. Over time, you don't just have a bigger tree, you have an entire forest. That's compounding. And compounding only becomes extraordinary when you don't interrupt it. So if I truly wanted to build significant wealth, no dividend checks to fund lifestyle early on, no constant skimming of gains. Let the machine run for decades. 9. I double Sometimes the things you don't do matter more than what you do. If I were starting over in 2026, here's what I'd absolutely stay away from. Everyone, no day trading. I wouldn't trade daily or weekly. No trying to predict short-term moves, no chasing green and red candles, no sitting in front of screens all day guessing. The data on this is brutal. The vast majority of frequent traders underperform the market badly, and many lose everything. No get rich this year plans. If any strategy course, guru promises financial freedom in 12 months. Able, double your money every 3 months. Sacred trading system Wall Street doesn't want you to know. I'm out. Real wealth is built steadily. It looks boring from the outside. Harks 3. No leverages. I wouldn't borrow money to buy stocks. No margin accounts. No using credit cards to invest. Leverage can turn a small mistake into a disaster. When I'm learning, I want forgivable mistakes. RC4. No buying what I don't understand. I don't care how hot it is, how viral it is, or how much my friend made last year. If I can't explain what the thing is, how it creates value, where the risk actually lives, I leave it alone. There will always be another opportunity. There will never be another. You protect your future self. If I step on $100, a kababao, I might or I might par car for I or par go ID cars RY. If I were starting over, I would not check my portfolio every day. I'd probably check it briefly once a month to make sure contributions are going in, seriously once a quarter to review the actual businesses I own. During those quarterly check-ins, I'd ask, has the business fundamentally changed? Is management making good capital allocation decisions? Is the balance sheet still strong? Did some new competitor change the long-term story? If something is broken structurally, not just temporarily out of favor, I'd be willing to sell, even at a loss, and move on. But if the business is fine and the stock is just down because markets are moody, I do nothing, or I buy more. Trading is like picking at a wound. Reviewing thoughtfully is like going to a doctor on a schedule. Font phrase step 11.9. Oyarnying to ITHE EDG. The hardest part of this entire plan isn't the math. It isn't reading financial statements. It isn't finding the next great company. The hardest part is waiting. We live in a culture of instant everything. Instant streaming, same-day delivery, viral fame in 24 hours, but money doesn't grow on a social media timeline. If I were 25 starting in $20.26, I'd set my expectations like this: 1 to 3 years. It might feel like nothing is happening. 7-10 years, I start to see real, meaningful progress. 25 years, the numbers start to look almost unreal. There's a saying, compounding is like watching grass grow, boring if you stare at it, amazing if you come back in a decade. So I'd protect my patience. I'd avoid hanging out in trading forums all day. I'd limit how often I check stock prices. I'd focus on increasing my income and savings rate in the real world, while my portfolio quietly works in the background. If I step 1, find GEOU or POPLE, investing can be psychologically lonely. When everyone around you is chasing the latest meme stock, gambling on weekly options, panic selling on every dippy woe, and you're just calmly buying index funds and a few quality businesses, you'll feel like the crazy one. So if I were starting over, I'd deliberately look for the ARZ right community, maybe a small group of friends who share a long-term mindset, an online community focused on fundamentals, not hype, a mentor or two. Even if it's just through books and letters, the people you listen to will influence your time horizon, your risk tolerance, your ability to stay calm when everyone else is freaking out. I'd be very picky about who I let shape my investing brain. The 100 started to LOD Evo LVE over 10 years. Let's fast forward. If I started from zero in 2026 and followed this plan, what would it look like in, say, $20.31 or 2036? Here's how I'd likely evolve. In early years, either to 5 years, heavy focus on growing my career income, most investing dollars into index funds, small, carefully researched positions in a few individual stocks, lots of reading, learning, and observing. Middle years, 15 years, higher savings rate as my income rises, maybe 40-60% of my portfolio still in index funds, 40-60%. in a concentrated group of 15 businesses I know well, more comfort adding during crashes. Because I've now lived through a few or SARS later years, ich plage years, and portfolio size starts to matter more than my yearly contributions. My job income becomes optional. I can slowly shift from growth and reinvestment to income and stability if I want. I start thinking seriously about legacy and impact at that point. Money stops being about stuff and becomes about choice, freedom, and options. Freedom to choose work you love, freedom to help family or causes you care about, freedom to say no to things that don't align with your values. 5 for step 430. If I successfully rebuilt from zero in 2026, I wouldn't just think about what I have, I'd think about who I can help. Because the most valuable thing you can pass on isn't a pile of cash, it's a framework. How to think about money, how to stay calm in chaos, how to play the long game. I'd teach my kids, my younger siblings, my friends who ask, maybe strangers through videos, writing, or mentoring, not to turn everyone into stock pickers, but to help them avoid the traps. High interest debt, lifestyle inflation, panic selling, chasing fads. Imagine being the person who breaks the cycle of money stress in your family for generations. That's a real legacy. So if I had to start over in 2026 with nothing but a regular job and a normal life, here's exactly what I'd do. 1. Stabilize first, pay off high interest debt, build a 3 to 6 month emergency fund, learn to live below my means on purpose. 2. I educate myself relentlessly, study the classic investing books, read shareholder letters, look at the world through a business lens. 3. Automate the boring, powerful stuff. Set up automatic investments into low-cost index funds, dollar cost average every month, no matter what the headlines say. 4. Train in the background, read annual reports, follow 10-15 companies closely, define my circle of competence. 5. Take my first focus shots. Start small with individual stocks I truly understand. Keep most of my money in index funds at first. 6. Let concentration grow with competence. Gradually build a focused set of best ideas. Keep a solid base in diversified funds. 7. Always keep some cash ready, 120% as dry powder. Use market crashes as opportunities, not reasons to panic. 8. Reinvest everything early on. Automatically reinvest dividends. Let compounding do the heavy lifting. 9. Avoid the biggest traps. No day trading, no gambling on leverage, no buying what I don't understand, no chasing guaranteed shortcuts. 10. Stay patient and stay the course. Review quarterly, not hourly. Focus on process, not daily prices. Give compounding the one thing it demands: time. You don't need a perfect timing. You don't need a crystal ball. You don't need insider information. You need a solid foundation, a simple plan, and the discipline to stick with it for longer than feels comfortable. The best time to start was years ago. The second best time, the only time you actually control, is right now. So if you're starting from scratch in 2026, here's my challenge to you. Before today is over, do one thing your future self will thank you for. Open the brokerage account, increase your 401 contribution, start the emergency fund, order that first investing book, just one step, then another tomorrow, and another next week. That's how real wealth is built in the real world, one decision at a time, one boring transfer at a time, one patient year at a time. Stick with that long enough, and one day you'll look around and realize you're not starting from zero anymore. You built something, and you did it the right way.